Usually when we talk about space exploration, there is this expectation of like absolute mathematical precision.
Oh, for sure.
You picture the engineering, the telemetry, you calculate the trajectory, you ignite the boosters, and you can map exactly where that rocket is going to be in orbit, like down to the absolute millimeter.
Right. Well, the physics basically mandate that kind of binary outcome, I mean, the payload either reaches orbital velocity or it falls back to Earth.
Right.
There is very little room for interpretation in orbital mechanics.
But then you look under the hood at the financial machinery powering those rockets, and suddenly that precision just completely vanishes.
Yeah, it really does.
You sent us this massive equity research report on Space Exploration Technologies Corp, or, SPCX, which I guess we are all adjusting to calling it now that it is publicly traded.
Yep, the new ticker.
Right. And looking at the notes you highlighted in the margins of this report for our deep dive today, we are looking at a financial landscape that is incredibly murky.
Murky is an understatement. I mean, diagnosing muddy waters is probably the best way to describe the Q2 2026 numbers in the research we're looking at.
Yeah.
When you start parsing through the top-line growth and the capital expenditure metrics of this specific quarter, you essentially have to throw out your traditional valuation models.
Just completely throw them out.
Basically, yeah. The standard metrics we use to value aerospace companies or even like high-growth tech companies, they simply break down when applied to what SPCX is currently doing.
Okay, well, let's unpack this. Because our mission today isn't just about rockets. It is about understanding this fundamental identity crisis happening inside this company.
Exactly.
We are diving into one of the most polarizing financial profiles of 2026 for you today. And we need to figure out, based on your analysis of the data, if SPCX's massive revenue growth is the ultimate trillion-dollar launch pad, or if it is actually a financial black hole fueled by this massive, totally unexpected pivot to artificial intelligence.
And that tension is the core of the entire equity report. You have this exceptional top-line revenue growth completely at war with, frankly, eye-watering capital expenditure.
Yeah, eye-watering is right.
And Wall Street is currently just standing on the sidelines trying to decide which of those two realities actually dictates the future of the stock.
So let's start with the shiny exterior first, that top-line boom, because on the surface, the numbers look like a total victory lap.
Well, they do. The Q2 revenue beat expectations and came in at $7.8 billion.
Which is just insane. That is a 92% year-over-year increase, right?
Almost doubling.
For a company dealing in heavy manufacturing and physical logistics, doubling your revenue in 12 months is almost unheard of.
It is staggering physical growth.
Mm-hmm.
But the nuance you have to focus on is where that cash is actually originating.
Right.
The historical core of the business, the space and launch segment, sending rockets to the ISS or putting traditional satellites in orbit, that only grew a relatively modest 29%.
Which brings us to the first massive surprise in this report. Over half of their entire revenue is now generated by Starlink.
Yep. The satellite internet segment.
Right. That division grew 66% to $4.3 billion. But the real shocker, the number that probably made you do a double take when reading this, is the AI solutions revenue.
That was the big one.
That segment surged 247% to hit $2.56 billion.
What's fascinating here is the underlying economics of that growth, particularly when we look at the Starlink expansion. Top-line revenue numbers can often mask degrading unit economics, and we really need to look at how they are actually making that $4.3 billion.
I am so glad you brought that up, because this is where I kind of have to push back on the Starlink hype a little bit.
Okay, let's hear it.
Well, looking at the data you sent us, there is a glaring contradiction in their user metrics. The subscriber base doubled, right? They now have 12 million active users across more than 150 countries.
Right.
On paper, that sounds like absolute global dominance. But the average revenue per subscriber, the ARPU, dropped by 22%.
It did, yeah.
To me, it's like opening a wildly successful restaurant franchise globally, but realizing you're only packing the tables every single night because you put every single item on the dollar menu. Are they just aggressively buying market share at a steep discount just to choke out competitors?
Well, buying market share is certainly a component, sure. But the mechanics of satellite internet economics explain why that 22% drop in average revenue isn't the disaster it might appear to be at first glance.
How so?
The drop in ARPU is largely a mechanical result of their international expansion. They're entering developing markets in South America, Africa, Southeast Asia, where they absolutely have to introduce cheaper pricing tiers just to capture demand.
Because they can't charge U.S. prices.
Exactly. You cannot charge a rural community in Brazil the same monthly rate you charge a tech worker in Silicon Valley.
But if they are slashing prices that drastically just to get bodies in the door, how does the business model survive?
Because of the fixed cost nature of the infrastructure.
Yeah.
Think about how traditional terrestrial internet works, right?
Okay.
If you want to add a new neighborhood to a fiber optic network, you have to physically dig up the street, lay miles of cable, install local nodes. The marginal cost of adding those specific users is incredibly high.
Right. It requires physical labor and materials.
But Starlink's infrastructure is already floating in low Earth orbit. Once the constellation's above a certain region, the signal is already there. The marginal cost of beaming that internet to a new user in Brazil is practically zero.
Well, outside of manufacturing the receiver dish, I guess.
But outside of the hardware they ship you.
So even if they are charging like a fraction of the U.S. price, almost all of that international subscription fee falls straight to the bottom line because the expensive part launching the actual satellite is already a sunk cost.
Precisely. And that is why, despite the steep drop in average revenue per user, Starlink generated approximately $1.6 billion in operating profit during this quarter alone. Yeah, that is a 79% increase in pure profit. The underlying economics of the constellation are just highly scalable.
But here is the catch that the equity report makes very clear. Starlink is the only profitable segment in the entire company.
Yes, the only one.
Every other division, Starship development, the traditional rocket launch business, and most notably their AI compute build-out, is aggressively consuming that $1.6 billion.
Rapidly consuming it.
They are burning through the Starlink cash so fast that the company-wide net loss was still $541 million for the quarter.
The profit engine is firing perfectly, but the vehicle it is attached to is just incredibly heavy. The capital being generated by the internet business is being immediately diverted to fund the next technological leap.
Which naturally forces us to follow the money. I mean, if Starlink is printing $1.6 billion in profit, but the company overall is still bleeding $500 million a quarter, we have to look at where this cash is vanishing.
It is being converted into raw computational power.
Here's where it gets really interesting, because the single most jaw-dropping statistic in this entire 50-page report is their capital expenditure.
It's massive.
In Q2 alone, SPCX spent $18.4 billion on CapEx. That is up 550% from just 1 year ago.
Right.
To put that in perspective for you, they only made $7.8 billion in total revenue. They are physically spending more than twice what they take in.
It is an aggressive, arguably unprecedented cash burn for a company that isn't operating in a hyperinflationary environment. And what really matters is the allocation of that $18.4 billion.
Right, because $15.8 billion of that total is tied directly to AI compute.
Almost all of it.
The report details that they are aggressively buying NVIDIA chips almost exclusively for two things: terrestrial data centers and orbital AI satellites. And before we get into the chips themselves, you have to explain the orbital AI concept. I am reading this and trying to figure out why on earth we're putting data centers in space. What is an orbital AI satellite, and how does it differ from the, terrestrial servers we have down here?
Well, the concept is rooted in solving the physical limitations of earthbound infrastructure. Terrestrial data centers require massive power grids and enormous amounts of water for cooling.
Right, they're huge resource hogs.
They are. But more importantly, they suffer from terrestrial latency. If a satellite captures high-resolution imagery of, say, a global supply chain bottleneck or military movements, it traditionally has to beam terabytes of raw data down to a ground station.
Which takes a ton of time and bandwidth, I imagine.
It does. It hits the ground station, which then routes it through fiber cables to a server, which processes it and then sends the actual insight to the user.
That sounds like a massive bottleneck if you are dealing with real-time global data.
It is. Orbital AI satellites, what the industry is now calling edge computing in space, they put the processing power directly inside the constellation.
Oh.
So the satellite captures the data. The onboard NVIDIA processors analyze it using AI models in real time. And instead of beaming down terabytes of raw data, it only beams down the final actionable insight.
That's incredible.
Yeah, it cuts the latency to milliseconds and frees up massive amounts of bandwidth.
So they're essentially building a localized brain in orbit rather than just a dumb relay station. But to build that brain, they are buying off-the-shelf NVIDIA hardware.
Right.
And the sources mention this is a massive pivot because SPCX previously stated they are going to vertically integrate and design their own proprietary chips in partnership with Tesla.
I did say that, yes.
Why abandon that plan when vertical integration has, always been their core philosophy?
No, if we connect this to the bigger picture, abandoning the custom Tesla chip integration reveals the sheer panic and urgency of the current AI arms race.
Panic.
Absolutely. Hardware development is slow. Designing, testing, and manufacturing a proprietary silicon chip can easily take a 3 to 5 year cycle. Artificial intelligence models, however, are advancing in 3-month cycles.
Ah, I see. You simply cannot wait 3 years for a custom chip when the market demand is compounding weekly.
Right.
By the time your proprietary chip rolls off the assembly line, it is fundamentally obsolete compared to the broader market.
Precisely. They chose speed over vertical integration, and this pivot completely changes their competitive landscape. By deploying $15.8 billion into NVIDIA hardware, SPCX is no longer just competing with aerospace legacy names like Boeing or Lockheed Martin.
They're playing a different game now.
They are now directly entering the arena against well-capitalized hyperscalers and neoclouds.
I want to pause on those terms because they are thrown around a lot in the financial media. When you say hyperscalers and neoclouds, how should we visualize this war they're entering?
Okay, imagine the digital economy is a massive global manufacturing industry. Hyperscalers companies like Amazon Web Services, Google Cloud, or Microsoft Azure are the massive general-purpose industrial parks.
Yep.
They provide the land, the power, and the basic factories for any company that wants to build software. Neoclouds, on the other hand, are the much newer, highly specialized boutique factories.
Got it.
They don't do general computing. They are designed exclusively from the ground up to process massive artificial intelligence workloads.
So by buying up all these chips, SPCX is essentially trying to build their own specialized AI factories, but doing it both on the ground and in orbit.
Exactly.
And they are actually landing major clients. The report notes they have secured commercial computing wins with Anthropic, Google, and Reflection AI. Their current run rate for AI compute revenue is tracking toward an annualized $28 billion.
They're essentially renting out the immense computational power they are accumulating. It is a highly lucrative business model, assuming you can finance the initial infrastructure build.
And that leads to my biggest skeptical pushback on this whole strategy: the financing.
The debt, yeah.
To pay for these specialized AI factories, they raised $25 billion in bonds. They now have roughly $29 billion in long-term debt sitting on the balance sheet.
Right.
And the projections in the equity report warn that if this current pace of capital expenditure continues, their net debt could hit $400 billion by 2031.
It's a staggering number.
Are they essentially betting the survival of an entire space exploration company on an AI gold rush?
That is the ultimate existential question facing the board right now. Management has explicitly communicated that they do not expect company-wide profitability before 2027.
Wow.
They are telling the market that capital spending will remain elevated through the rest of the year. Their core thesis is that providing the infrastructure for the next generation of artificial intelligence will ultimately generate cash flows that completely dwarf the revenue of merely launching physical payloads into space.
But the debt load is climbing at an exponential rate, and their free cash flow is deeply in the red, which makes me wonder how Wall Street is attempting to price a company that is growing revenue at 92%, but simultaneously spending twice its revenue on servers.
It's tough.
The financial modeling here feels entirely schizophrenic.
You see that schizophrenia, perfectly mirrored in the stock's daily performance and the wildly divergent analyst ratings. The stock is exhibiting extreme volatility right now. The research report notes it currently has a beta of 6.55.
Let me translate what a beta of 6.55 actually means for you if you are watching this stock in your portfolio. The broader market, say, the S&P 500, has a beta of 1.
Right.
If the market moves up or down 1%, a stock with a beta of 1 will generally follow suit. A beta of 6.5 means if the S&P 500 drops 1% on a Tuesday, SPCX is statistically expected to violently swing over 6.5%.
It is a complete roller coaster.
It is, and the institutional analysts are just as divided as the price action. You have Macquarie reaffirming a $250 price target with an outperform rating, arguing that the AI revenue growth makes the current price look cheap.
Right, the bulls.
But then you have Morningstar reaffirming a $62 fair value estimate, explicitly calling the stock significantly overvalued, and assigning it only a narrow economic moat.
The market simply cannot agree on the primary narrative. We saw shares fall roughly 28% over a 30-day period prior to a recent bounce.
Oh, that was a brutal drop.
That included a very sharp 13.6% drop immediately following the earnings print, when the market first digested that $18.4 billion capex figure.
But it didn't stay down. The stock violently bounced back, jumping 23% off a 52-week low of $104.83 just over the last few trading sessions.
This raises an important question regarding market mechanics. Is that 23% surge a genuine trend reversal because large institutional buyers suddenly digested the AI strategy and believe the debt is manageable? Or is it merely a temporary short covering rally?
Break down that short covering dynamic, because I feel like it can often create false positive signals for retail investors.
Well, when traders believe a stock is going to fall, they short it, meaning they borrow shares and sell them, hoping to buy them back later at a lower price to return them.
Right.
When SPCX hit that 52-week low, many of those short sellers likely decided to lock in their profits. To do that, they have to buy the stock back.
Which creates demand.
Exactly. When massive amounts of short sellers buy the stock simultaneously just to close their positions, it creates an artificial spike in demand, driving the price up 23%. It looks like a bullish rally, but it's actually just bears closing their bets.
But there is one major piece of institutional validation in your sources that suggests it might not just be short covering.
Oh, the Norway news.
Yes. Norway's sovereign wealth fund, which manages over $2.3 trillion and is famous for being incredibly methodical, risk-averse, patient, they just took a $1.2 billion stake in SPCX.
They did.
How does a methodical long-term fund justify buying into a high-beta stock with $29 billion in debt?
Institutional capital of that magnitude operates on a very different time horizon. They're not looking at the Q3 capex burn, They're modeling out the cash flows for 2035.
So they're looking way past the current cash burn.
They likely view the massive debt accumulation not as a cliff, but as a necessary bridge to establish a monopoly in space-based compute. If you believe orbital AI is the future of global data processing, $1.22 billion is a very reasonable entry price for a dominant position.
I understand the 20-year horizon, but how do you square that with the immediate retail and independent sentiment? You look at the Seeking Alpha contributors cited in the report, and then you're just pounding the table calling SPCX a strong sell.
Right, the valuation bear.
Their primary argument revolves around the valuation multiple. The stock is currently trading at a 59 times price-to-sales multiple.
And the mechanics of a 59x price-to-sales multiple require serious context. It means you are paying $59 today for every single dollar the company generates in top-line sales over an entire year.
Sales. Not profit.
Not profit, just raw sales. To put that in perspective, if the company magically had a 100% profit margin and paid every single cent of revenue to you as a dividend, it would still take 59 years just to make your initial investment back.
And there are zero actual earnings right now to even calculate a traditional price-to-earnings ratio. At a 59x multiple, the market is pricing in absolute flawless perfection for the next decade.
Flawless.
They are assuming the AI compute segment dominates Google and Amazon, that Starlink maintains a global monopoly despite geopolitical pushback, and that Starship revolutionizes heavy launch costs without a single major catastrophic failure.
It's a lot of assumptions.
There is virtually zero margin of safety. If any one of those three pillars even slightly wobbles, the valuation collapses.
And that fragility leads directly to the most critical structural event facing the stock right now. The market might not even have time to debate the long-term fundamentals of the 59x multiple because there is a mechanical supply shock about to hit the market that overrides everything else.
You are talking about the lockup expiration.
I am.
For anyone unfamiliar with how IPOs and public listings work, when a company goes public, the early private investors, the venture capitalists, and the employees are legally locked into holding their shares for a specific period.
The mechanism is designed to prevent insiders from immediately dumping their equity on retail investors and completely crashing the stock price on day one.
The structural risk here is that less than 5% of SPCX's total outstanding shares are currently publicly tradable.
It's a tiny float.
That is a tiny public float, which is partly why the beta is so high it doesn't take much volume to move the price. But according to the schedule in the equity report, approximately 900 million shares are having their lockup expire right now.
Right now.
They are legally allowed to be sold on the open market. And by mid-2027, a staggering 12.9 billion shares could become eligible to trade.
It is the definition of an acute supply shock.
If less than 5% of the shares are trading now, dumping 900 million new shares into the system is like trying to merge a 10-lane highway of rush hour traffic into a single-lane dirt road.
That is a great way to picture it.
My deduction here is that it almost doesn't matter how good the AI revenue growth is. If early investors look at that $18.4 billion capex bill and decide they want to secure their profits now, the sheer volume of selling pressure will break the stock price purely based on supply and demand.
Your deduction is absolutely correct. The lockup expiration is the most immediate existential threat to the stock's near-term stability. If the institutional demand cannot absorb that waves of insider selling, the price will gap down violently, regardless of the underlying business fundamentals.
So we have a deeply divided market, escalating debt, a ticking time bomb of share supply, but undeniably spectacular revenue growth. You have analyzed the data in the report. What is the map forward? How do we track if the company is actually surviving this?
We have to focus entirely on the upcoming Q3 earnings print, which is expected in late October or November. The equity report outlines a very narrow but credible recovery scenario for the stock.
Okay.
There are specific fundamental and technical metrics we need to watch to determine if the bullish thesis is actually playing out.
Let's walk through them so we know exactly what to look for on earnings day.
Metric number 1 focuses on the yield of their spending. AI revenue needs to strictly exceed $3 billion for the quarter.
Okay, so that would prove that the $15.8 billion they spent on NVIDIA chips isn't just sitting in a warehouse somewhere. It proves the massive capex investment is actually converting into high-margin, recurring revenue and doing so immediately. It shows the new plumbing they built is actually carrying water.
Precisely. The market needs proof of immediate monetization. Metric number 2 addresses the fear of the debt spiral. Q3 capital expenditure needs to drop below $14 billion.
So if they print another $18 billion capex quarter, the market will assume the bleeding is unstoppable and the funding gap narrative will completely take over.
Exactly.
Dropping below $14 billion proves that the Q2 spending was like a one-time infrastructure peak, and they are finally moving toward a self-financing cycle where Starlink and AI can kind of pay for themselves.
Correct. They have to prove the peak intensity of the bill-out is in the rearview mirror.
So if metric 1 proves the AI makes money and metric 2 proves the spending is cooling down, metric 3 has to be about surviving that supply shock from the lockup expiration.
It is entirely about price action and absorption. The third metric is that the stock needs to reclaim the $170 plus level on sustained heavy trading volume.
Because if it can climb back above 170 while 900 million new shares are flooding the market, it definitively proves there is enough massive institutional demand. Buyers like the Norway's sovereign wealth fund stepping in to absorb all that new supply without breaking the stocks back.
Yes.
It shows the big money believes the worst is over.
If all three of those metrics are met, the recovery scenario is validated, and the 59x multiple begins to look justifiable as the revenue aggressively scales.
So what does this all mean? If we pull back from the lockup dates, the beta volatility, and the price targets, we are looking at a company that is undeniably structurally dominant in its physical field.
Without a doubt.
They essentially own the reusable launch market. Starlink has an incredible, almost insurmountable first-mover advantage with 12 million global subscribers. And their AI compute run rate is already going toe-to-toe with established legacy tech giants.
The foundational business is remarkable. But the capital intensity profile of their current strategy leaves absolutely zero margin of safety for the investor.
Zero.
It is a high-risk entity right now because the gap between the cash being burned to build the future and the cash being generated today is historically wide.
It really feels like the next 2 quarters of execution aren't just important for maintaining a price target. They are a matter of absolute financial life and death for the current valuation.
Very much so.
If management executes this pivot perfectly, they build a multi-hundred-billion-dollar empire that controls both global connectivity and orbital artificial intelligence. If they miss their targets, or if the NVIDIA chips don't yield the expected margins, that $29 billion debt load becomes a permanent anchor.
And stepping back from the pure financial mechanics, the data in this report leads to a broader, almost philosophical question that I think is really worth considering after digesting all these numbers.
I always appreciate where these deep dives take us conceptually. What is the takeaway?
SPCX was fundamentally founded and designed to explore the physical universe.
Right, going to Mars.
Exactly. The core mission was to make humanity multiplanetary, to engineer physical solutions to physical boundaries. But right now, based on their own financial reporting, they are spending roughly 85% of their massive capital expenditure to build digital artificial intelligence infrastructure.
Yeah.
They are allocating their treasure to buy NVIDIA processing chips, not rocket fuel or titanium.
When you frame it in stark percentages like that, it represents a massive identity shift.
So what does that say about the broader trajectory of technological progress? If the most ambitious, well-capitalized physical engineering and aerospace company in human history feels compelled to pivot and become an artificial intelligence compute provider just to remain economically viable,
Right.
is the real frontier of human expansion no longer out there in the physical stars? Is the only frontier that actually matters right now located inside the servers?
That is a wild thought to leave on. You expect the future of this company to be mapped out perfectly, operating with the precision of a rocket trajectory. And instead, digging through this research, you find out the actual destination completely changed while the rocket was already in midair.